Okay, so in this tutorial we're going to look at the assignment question for FSC 2601 assignment 2 for 2021, and we've got the question here. The following information was extracted from the accounting records of Revalued Limited on 30 June 2020. So that's the financial year, and there landed cost is given, but we are referred to Note 1. Factory and office building, we are referred to Note 1 and 2. There's a question mark. Machinery and equipment, that's on Note 3. And motor vehicles, it's also given, but we're being referred to notes. Accumulated depreciation of the assets is also given, but before we read the notes, let's look at the requirements of the question. Disclose the information and the statements of financial position of Revalued Limited as at 30 June 2020 to comply with the requirements of International Financial Reporting Standards. Disclose only the note to property, plant, and equipment. Alright, so this is the key part of the question that we're gonna do, the note to property, plant, and equipment. Simply because when you go to the statement of financial position, we're just gonna extract what we would have covered in the note to property, plant, and equipment. So that's what we want to record on there. Okay. So let's go back and look at the information. Now, our financial year end is as stated there. That's 30 June 2020, which means our financial year is running from let's just put here. That's 30 June 2020. That's the end of our financial year, which means the year is running from 1 July 2019. 1 July 2019. So we've got the beginning of the financial year. I've just decided to put it on there, and then the end of the year is there. So when we are doing financial statements, you should note that usually we have accumulated depreciation at the beginning, which is at this date. So we need to calculate the carrying amount at the beginning of the year, which is at 1 July 2019, and then at the end of the year we need to calculate the carrying amount as well, which is at 30 June 2020. So we're going to look at all those figures as we approach this question. Okay, so depreciation rates are given for motor vehicles is 20% per annum according to the straight line. Factory and office buildings are at 2% per annum according to the straight line. Machinery and equipment is at 20% according to the reducing balancing. So we need to take note that when we're dealing with machinery and equipment, it's actually reducing, and when you're dealing with motor vehicles, it's straight line. Factory is straight line. So those are the key touchstones there on our depreciation rates. Now, we should also take into account that we're given land there, but land is not normally depreciated. It is actually, in most cases, revalued. So let's look at what happened with Revalued Limited. Revalued Limited acquired and occupied the land on which the factory and office buildings are erected on 1 July 2017 at an amount of 1 million. The land was revalued for the first time, which is on 29 June 2020. So that's the current financial year. It was only revalued in the current financial year. So our valuation of our land is going to affect our financial records as of the current year by Mr. King, an independent sworn appraiser, at a fair market value of 1 million. So the land was revalued from 1 million to 1.5 million by Mr. King, an independent sworn appraiser. The factory building was constructed on the land on 1 August 2017 and completed and available for use on 1 January 2018. The cost of the factory building amounted to 2.4. Okay, so for the meantime, let's deal with the revaluation of the land. Okay, so I've the template here already given. The land had a cost of 1 million at the beginning. Okay, 1 million. So that's given there. Let me just put alright, so that it will be easy for me to see. Okay, so 1 million at the beginning. It was revalued to 1.5 million. So, which means the difference between those two amounts is what we will put in our revaluation account. So the moment we say revaluation here, we're going to look at the difference between these two amounts. The cost at the beginning and the cost at the end. Why? Because there is no accumulated depreciation for land. So accumulated depreciation will be 0, which means the cost is exactly the same as the carrying amount. And then here accumulated depreciation is also 0, which means the cost is exactly the same as the carrying amount. Okay, depreciation capitalized, there's nothing like that there. Depreciation for the year, we are not depreciating. Disposals at carrying amount are not one. They never said that they disposed anything. They never told us about additions as well. So this is land and buildings. So we move on to look at the buildings. This is just the land. So we are now moving on to look at the buildings and see what happened there. So the land was revalued. Okay, we're done with that. The factory building was constructed on 1 August 2019, right? And then here we're not given the accumulated depreciation, which means we might have to figure that ourselves. And completed and available for use on 1 January 2018. So when we are depreciating this, we need to take into account the date that it was available for use, not the date that it was constructed. So depreciation is going to be calculated from 1 January 2018, and the cost of the factory building amounted to 2.4. Alright, so we need to know the depreciation from 1 January 2018, which is a date here. It was constructed for 2.4 million. That's the building. It was constructed at a cost of 2.4 million on 1 January. That's on 1 January 2018. So here our date is 1 January 2018. Now we need to calculate the months from 1 January 2018 to July, to 30 June, basically, 2019. And we can see that 1 January to 30 June 2018, that's going to be 6 months there. And then up to the current year, that's going to be 12 months. And then 6 months here. So basically that's 1.5 years up to the beginning of the current year. So if we are just depreciating this building, we're going to say, okay, since we had it for 1.5 years, we're going to say buildings at cost, yeah, at 1 Jan 2018, right? And then depreciation, so this is going to be the 2.4. This is 2.4 million. Alright? Depreciation there from the date that it was available for use. Let's say accumulated depreciation. Depreciation up to the beginning of the current financial year. Well, that's basically 30 June 2019. That's the beginning of the current year. So you can just say accumulated depreciation up to 30 June 2019. That will be enough. I'm just adding this information to just help you see. Alright, so that depreciation, we're going to calculate it as follows. The rate of depreciation on buildings is 2%, which is 0.02. And this is being depreciated using the straight line method. So it turns 1.5 years. 1.5 because we had it for 1.5 years, and then multiplied by 2.4 million. Right, so that will give you the depreciation on buildings, accumulated depreciation on buildings. So we put it there. Okay. So I'm just fixing the formula there. So 72,000, that's accumulated depreciation. Okay, let's read for more information on the buildings to see if there is anything that we still need to know. So that was the cost at the on 1 January 2018, and then we've calculated the accumulated depreciation. After note number 2, which also affects factory and buildings. After expansion of operations, an office building was built. The office building was completed and available for use on 1 December 2019. The following expenses were incurred in building the offices: labor, material. Okay, so all these things happened as of 1 December 2019, which is the current year. So if we're talking about what happened before the beginning of the current year, there's nothing. The 2.4 building was just there. So we're going to enter this information there as our cost at the beginning, which is 2.4 million. And then accumulated depreciation, we've calculated that's there. And then carrying amount there, it will be the difference between this and that at the beginning. So that's the carrying amount of our buildings at the beginning. Now, there were some additions during the year that we need to take care of. Additions to buildings. That's what we're going to take care of now, which is so that's what they're talking about here. After expansion of operations, an office building was built. The office building was completed and available for use on 1 December 2019. The following expenses were incurred in building the offices: labor costs and material costs were incurred. So those are the cost of the materials is part of the additions. So labor, material. So on labor they said the cost is 450,000. So we'll put it there. And then on materials they said 150,000. Okay, to make a total of, which is the sum of these two, that forms our additions, 600,000. So on additions to buildings, we're going to put the 600,000. But is that all? Let's check what they have to say as well. Now, on note number 3, the company withdrew its machinery and equipment from normal production for a period of 4 months during the current year, from 1 July 2019, and used it in the construction of the office building. So here brings another interesting case of no machinery and equipment or purchased or sold during the year, of depreciation capitalized. So for us to deal with this issue, we need to first of all look at what happened to machinery. Fortunately, they've told us that no machinery was purchased or sold during the current year, which means we just have to talk about the depreciation capitalized. Depreciation capitalized is calculated when we use our own equipment or our own material in order to create another asset of our own. In that case, the cost of depreciation is added to the cost of the asset that we are building for the period that we withdrew our equipment to build that asset. Right. So we are saying the depreciation that we will calculate for our equipment will be subtracted from equipment and added to the cost of our building in this case. Why? Because we used our equipment to create our own building. So let's look at that, how that works. We need the cost of our equipment at the beginning. So machinery and equipment had a cost of 3 million. So we're just going to enter that in. Fortunately, they told us that our equipment maintained the same cost from the beginning to the end. No equipment was added, so the cost of our equipment there is still the same. It is that, but of course the depreciation will be different. Let's look at the accumulated depreciation on equipment, which is also given Machinery and equipment at the depreciation of 1,080,000 at the beginning, so we put that there, and then we can calculate the carrying value there, which is basically the difference between the two. So that's the carrying value of our equipment. Now, how is equipment being depreciated? Machinery and equipment is 20% per annum according to the reducing balance method. So we can calculate depreciation on equipment right away because we had this equipment throughout the year. So depreciation for the year there is going to be based on the carrying amount of the equipment. So we just calculate 20% based on the carrying amount. So that's the depreciation for our equipment because it's reducing balancing. 20% per annum is given there, if you can see. Alright, now on that depreciation we need to deduct depreciation capitalized, which is this, but it was withdrawn from normal use for a period of 4 months out of a total of 12, right? So that's depreciation capitalized. So we are subtracting it from here, and then we are putting it on office buildings. Alright, so here to our office, so this is the process of capitalizing. You are deducting on equipment because you withdrew your equipment from normal use and adding it to factory buildings. Now, the total cost of additions are there, so you're going to add depreciation capitalized. Which is equal to the 128 there. Now, this is going to be the total cost of additions. All this is in your workings. Now, the total cost of your additions is going to be the sum of this and that. So, your additions have a total cost of that much. But how is that going to help you? You need to calculate depreciation on additions. Of which, this you're calculating from the day that they were available for use. That's how we always calculate depreciation. It is calculated from the day the asset is available for use. So, the company withdrew its machinery and equipment from normal production for a period of 4 months during the current year from 1 July. So July, August, September, October. From 1 July 2019 and used it in the construction of office building. No machinery. Okay, so you add it to there. So for the 4 months, we calculated the 4 months and we added it to that amount there, and then we got our amount. And then this office building was only available for use from 1 December 2019. So from 1 December 2019, we're going to calculate depreciation. So December 2019 up to the end of the current financial year. But our current financial year ends on 30 June. So we're calculating December to 30 June. So December, January, February, March, April, May, June, December, January, February, March, April, May, June. So that's 7 months. So let's calculate depreciation on there for 7 months. So that's 7 over 12 times 2% times 728. So that will give you 8,493. So that's your depreciation on additions. I'm just going to remove the zeros there to make it look nice. Okay, so that's your depreciation on additions given there. And then you still need to calculate depreciation for the year on okay, so on the other buildings. So depreciation for the year on other buildings. These are the buildings that were there throughout the year, which is going to be depreciation is 2% on cost. So 2.4 multiplied by 0.02. So total depreciation on buildings is now going to be equal to the sum of these two. So 56,493 is your total depreciation on buildings. Okay, so that's your total depreciation on buildings, and that's your depreciation capitalized. So when you're calculating your carrying value for buildings at the end, you're going to take the carrying amount at the beginning plus additions minus your depreciation for the year plus depreciation capitalized. So that's that. And then your cost at the end is just going to be the cost at the beginning plus additions, in this case, plus depreciation capitalized. That's your cost. And then your accumulated depreciation is going to be your accumulated at the beginning plus your depreciation for the year. That's that. So that's how you calculate that. And then we come back to machinery, which I think we are already done with. We just need to calculate our accumulated depreciation, which is 384 minus the depreciation capitalized, because we're removing that. So that's 256. And then our carrying amount there will be the difference between the two, the cost and the accumulated depreciation. So that's that. So that's machinery up to machinery there. And then let's look at motor vehicles. What happened with our motor vehicles? And what's the story there? That should be interesting. Okay, on 1 February 2020, a motor vehicle with an original cost of 205. Alright, remember our motor vehicles are given here at cost. Motor vehicles at cost is 645, it's given. But they did something here. On 1 February 2020, a motor vehicle with an original cost of 205,715 and on which depreciation of 95,715 was already written off on 1 January 2019 was traded in. So it was sold, right, for a new vehicle. So they also bought a new vehicle with a cost of 336. The motor vehicles was acquired for business purposes, but the transaction has not yet been recorded in the accounting records of the retailer. Okay, the fact that the transaction has not yet been recorded, it means that the value that they've given us here does not include does not include the new vehicle, and they have not yet removed the vehicle that they have sold. So this is essentially the cost at the beginning. So we're just going to go and run to put that in our transactions there, in our note. So the cost there is 645,715. And they've given us the accumulated depreciation there, which is 235,715. And it's given at the beginning. That's why we're taking it to the beginning. 235,715. So the 235,715. Now, the carrying amount there will be the difference between the two. So, that's our carrying amount at the beginning there. Now, additions, they did add some vehicles. They told us they bought some vehicles for 336,000. Let's just check where they said that. Here. It was traded in for a new vehicle costing 336,000. So you just put that in, 336,000. Those are your additions. So you put that in, and then now we need to calculate what happened on the vehicle that was sold. Now they told us that they sold a vehicle, they traded in a vehicle with a cost of 205. So here I'm just going to write motor vehicles. Alright, and then disposal at cost. The disposal at a cost of 205,715, like said, and then accumulated depreciation on the on 1 July 2019 for the asset that was disposed, which is at the beginning of the year. It was given as 95,715, which means the carrying amount on the vehicle that was disposed is the difference between the two. Alright, now how are vehicles being depreciated here? Motor vehicles 20% per annum according to the straight line method. Okay, so we want to calculate the depreciation for the year on up to the date the asset was disposed. So the asset was traded in on 1 February 2020. So we count the months from the beginning of the year, which is on our year is starting on 1 July 2019 up to 1 February 2020. So that should be July, August, September, October, November, December, January. So that's 7 months. So we are calculating depreciation for 7 months on there based on the cost, because they said motor vehicles is 20% per annum on cost. For a disposed asset, we calculate the depreciation based on the month that we had the asset. So we're going to calculate depreciation on depreciation on asset disposed, and that is going to be, I'm saying you have to say 7/12, because you had it for 7 months out of the 12, and then you're going to say times 20%, then times the cost, which is 205,715. That's how you're calculating the depreciation there. So you just put that in there. So the depreciation there gives you 24,000. Now, disposal at carrying amount, on the date that the asset was disposed, you're going to take this minus that. Okay, so because I don't like the zeros, I'm just going to say, okay, all these values, let's just take out the zeros. Okay, so the disposal was 86,000 there. So we're just going to put that in disposals at carrying amount, which is going to be 86,000. All right. And then when you are trying to calculate the depreciation for the year, when you're calculating the depreciation for the year, depreciation for the year, you need to calculate this additions at cost. You need the additions at cost. We know that it's equal to the 336,000, but we only got this asset on which date? On 1 February 2020. So we calculate from 1 February 2020 up to the end of the current financial year, which is 30 June 2020, and that's February, March, April, May, June. So that's 5 months. So we're gonna calculate depreciation on additions, and that is going to be the 336 times 5 over 12 multiplied by we had it so the depreciation rate is 0.2, which is that. So that's the depreciation on additions. Now we also need to calculate depreciation on other assets that we had throughout the year. Right, let me just say cost of other asset. Now the cost of these assets is going to be the 645,715 minus the cost of the asset that we sold, because we no longer have that, which is 205,715. So that's the cost there. But we had these assets for the entire year, so depreciation on them, you're going to say 0.2 times their cost, because depreciation is at cost. So that will be your depreciation on them. Alright, so that's so that's the depreciation on other assets, and then total depreciation is on vehicles is now going to be equal to depreciation on disposed asset, which is given, which we've calculated actually, and then depreciation on additions we calculated, and depreciation on the assets that we had throughout the year that we calculated. So the total is 140,000. So you're going to take that in. Depreciation for the year is going to be equal to 140,000. Okay, from there you then there's no depreciation capitalized on vehicles, so you just put a 0, and then you calculate your carrying amount at the end. Your carrying amount at the end is now going to be your carrying amount at the beginning, which is 410 plus additions, minus your disposals at carrying amount, and then minus your depreciation, which gives you that amount. Your cost at the end, you know the cost at the beginning, minus disposals at cost, because you no longer have this asset, plus additions, and then you get that. Then your accumulated depreciation, that's your accumulated depreciation at the beginning, and then plus your depreciation for the year, which is 140, minus, of course, you need to remove all the depreciation relating to the asset that you sold. So accumulated depreciation on asset disposed, and then minus depreciation for the year on asset sold. Alright, so that's how you working this question out, and then you can just do the totals there. So the totals are the sum of that, and then you just scroll that down up to the end. So these are your figures, these are your totals. That's your situation. It's up to you whether you want to remove the zeros, but this is the property, plant and equipment note at that particular date. So you can write on top there the property, plant and equipment note for Delata Private Limited, and then you need to make sure, guys, that you include your workings. So all these are my workings, and this is my property, plant and equipment. So here I'm just going to write workings on top, and then here I'm going to write PPE note for Delata Ltd as at 30 June 2020. Alright, so we've come to the end of this video. Thank you for watching.